Welcome, everyone. We're diving into the seismic shifts happening in the silver and gold markets. I have critical information to share, reasons for immense optimism, but we must begin with a significant warning. I am hearing growing concerns, and the evidence supports it. We could see extreme volatility in the general stock market in the coming weeks. Investor psychology has shifted. After reaching sky-high valuations, the market is nervous, ready to take profits. I'm not a financial advisor, and I don't have a crystal ball, but I want to prepare you. Monday could be a significant down day. The critical question is, will this drag down silver and gold? The answer is, not necessarily. This time, things are fundamentally different. The inevitable consequence of the current economic and political landscape in Washington is more liquidity, more money printing, and a loss of value for the US dollar. And since we measure precious metals in dollars, this creates an unshakable foundation for their long-term rise. Over the coming months, quarters, and years, I am confident we will see prices for precious metals that we once only dreamed of. Now, let's get to the source of our optimism. Top analyst Dave Early, in his Junior Miner Junkie newsletter published by Kitco, has laid out a powerful blueprint for silver. He highlights several key factors that should make every silver investor very happy. First, let's talk about historical context. Silver's inflation-adjusted high from 1980 isn't $50. It's a staggering $200 per ounce. This isn't wild speculation, it's a simple calculation based on the Consumer Price Index. Second, and perhaps more importantly, is the gold-to-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. It's been falling and is approaching a key support level of 75-1. But look at history. At the peak of the 2011 bull market, the ratio hit 30-1. In the 1980 bull run, it reached an incredible 15-1. Let's do the math. If gold stays at $4,000 and the ratio contracts to 30-1, that implies a silver price of $133 per ounce. If it reverts to the 1980 level of 15-1, we are looking at a mind-blowing $266 per ounce silver. These are not fantasy numbers, they are based on historical market cycles, and there is nothing stopping us from returning to them. Beyond the ratios, we are witnessing a perfect storm of technical and physical market forces. Technically, silver's quarterly close above $46 at the end of September was a monumental event. It represented a powerful breakout from a 45-year cup and handle pattern. For those familiar with technical analysis, this is one of the most reliable chart patterns in existence, and the longer the pattern forms, the more powerful the breakout tends to be. But the real bombshell is in the physical market. Last week, a historic and rare event occurred: backwardation. For a brief period, the spot price of silver in London traded nearly $3 higher than the futures price. What does this mean? It signals an immediate, desperate demand for physical silver that vastly exceeds the available supply. Futures traders are struggling to deliver actual metal against their paper contracts. Historically, such conditions have preceded parabolic price explosions. This is compounded by a fundamental supply issue. Over 70% of all newly mined silver is merely a byproduct of mining for other metals, like copper and zinc. This means that even a significant price spike will not quickly unlock a new flood of silver supply. The mines simply aren't there. The evidence is now so overwhelming that even the mainstream financial media can no longer ignore it. Bloomberg, the heart of the financial establishment, recently published an article titled "Historic Silver Squeeze Deepens as Prices Soar in London Market." More importantly, major financial institutions are telling their clients to buy gold for the first time in decades. Mike Wilson, the chief investment officer of Morgan Stanley, recently recommended a 60-20-20 portfolio: 60% stocks, 20% bonds, and 20% precious metals. Even the bond king, Jeffrey Gundlach, is advocating for a 25% allocation to precious metals. Consider the tidal wave of money this represents. The entire combined market cap of every single gold mining stock traded in the United States is about $600 billion. To put that in perspective, the tech giant Nvidia has had single-day price movements larger than the entire gold mining sector. When even a small fraction of the general investing public, the sheeple, start moving just a tiny percentage of their portfolios into this tiny sector, it will be like a wave hitting a pond. The effect will be explosive and will benefit both mining stocks and physical metal. People often say, "This time is different," and it's usually a trap. But for silver, this time truly is different. Let's compare. 1980. The spike was driven by the Hunt brothers cornering the market, a speculative squeeze. 2011. The spike was a reaction to the money printing after the 2008 financial crisis. 2021. Another spike driven by pandemic-era stimulus and money printing. Today's move is different. It is not a mere spike, it's a sustained breakout driven by a combination of technicals, a physical supply crunch, and rising industrial demand. Crucially, the Federal Reserve hasn't even started a new round of quantitative easing yet. The real money printing is still to come. Furthermore, the global landscape has changed. In the 1980s, the economies of China and India were minor players. Today, they are economic superpowers with a deep cultural affinity for precious metals, and they are increasingly seeking to control the pricing mechanisms. This creates a new, powerful source of demand that simply did not exist in past cycles. Buckle up. We are in for a wild ride. The convergence of these factors suggests we could be sitting here a year from now discussing silver at $100, $130, or even higher. These numbers are not crazy, they are mathematically and historically plausible. Thank you for joining me. Remember, I am your friend in the market, not a licensed financial advisor. Please be responsible, do your own research, and make informed decisions. I look forward to seeing you next time as we continue to navigate this historic journey together.